Property developers often chase the thrill of groundbreaking ceremonies and towering cranes. Yet, in 2025, Robinson's Land Corporation proved that stability can be even more impressive. Growth didn't come from spectacle or short-term accounting wins. It came from the fundamentals: tenants, leases, and steady handovers. Gross revenues climbed 13% to 48.52 billion pesos. EBITDA rose 10%, and net income grew 5% to 16.17 billion pesos. While margins softened compared to last year's one-off gains, the core engine remained robust. Earnings per share increased to 2.80 pesos, a quiet testament to unwavering discipline. What made this performance possible? Real diversification. RLC's 6 divisions: malls, residential, offices, hotels and resorts, logistics, and destination estates, spread risk and reward across the portfolio. Malls led the way, responsible for 41% of revenue and nearly half the EBITDA. Rental income rose 10%, anchored by 57 malls and over 3 million square meters of floor space. In a country where malls shape city life, that is a foundation with true staying power. Residential delivered dynamic growth, with real estate sales surging 59%. 90 condominium and housing projects, plus 44 subdivisions, provided a strong pipeline. This segment lifted revenue, but didn't put the entire group at the mercy of housing cycles. Offices brought higher margin quality, even in a market where vacancy rates remain challenging. RLC expanded flexible workspace centers to 16 locations, proving that well-placed offices for BPOs and multinationals still thrive with selective optimism. Hotels and resorts are no longer an afterthought. With 27 properties and over 4,400 rooms, including premium and budget brands, the segment's revenue rose 8%. Add logistics, destination estates, and a growing urban ecosystem, and the company's breadth becomes a shield against singular risks. Yet, the real story sits quietly on the balance sheet. Total assets grew, but equity rose faster. Debt to equity improved to 0. 23-1. Liquidity metrics strengthened. Interest coverage reached 6.87 times. Cash flow supported expansion and dividend increases, signaling a shift toward investing from strength, not strain. This steady approach may not guarantee excitement, but it brings resilience. RLC's disciplined diversification means it needs less drama from the market and more from structure and execution. For investors, analysts, and stakeholders, this is what progress looks like: a company that is becoming more interesting precisely because it no longer depends on being exciting.